You want to reach a point in trading where losing money becomes the rare exception instead of the daily pattern. You must first understand one truth: the market does not take your money, you give it away. Every loss you've ever taken came from a decision made long before the trade was placed. The real battleground is not the chart, not the strategy, not the market conditions. The real battleground is your internal structure, your beliefs, your expectations, your fears, and the way you respond when uncertainty presents itself. Never lose money is not a promise of perfection. It is a mindset, a disciplined framework in which you refuse to let your uncontrolled impulses make financial decisions on your behalf. The majority of traders think losing money is a technical problem. Wrong. Indicator, wrong. Entry, wrong. Risk to reward. But the consistent trader understands that losing money is almost always a psychological problem. You don't lose because the market moved against you. You lose because you hesitated when the signal came, or you jumped in too early, or you refused to accept a small loss and transformed it into a large one. Every consistent trader eventually discovers that the market is neutral. It doesn't care. It doesn't reward intelligence. It rewards discipline. It doesn't punish ignorance. It punishes the inability to adapt. To avoid losing money, you must transform the way you interact with uncertainty. The concept of never losing money begins with redefining what a loss actually is. A small, controlled stop loss is not a loss. It is the cost of doing business. A real loss is when you violate your own rules, when you trade emotionally, when you allow fear, greed, or impatience to override your plan. You can enter the same setup 10 times and make money on only 4 of them, yet still end the week profitable if you cut your losses without hesitation and allow your winners to unfold without interference. Consistency doesn't come from accuracy. It comes from the way you handle the inevitable uncertainty of every single position. To reach a level where you rarely lose money, you must build an identity that aligns with the actions of a consistently profitable trader. That identity is constructed from 3 pillars: absolute confidence in your system, total acceptance of risk, and unwavering trust in the probabilities. When you truly accept the risk before entering the trade, fear disappears. When fear disappears, you stop reacting emotionally. And when emotions no longer dictate your actions, losses shrink automatically. The market becomes dangerous only when you enter it with untested beliefs and unrealistic expectations. But the moment you train your mind to operate objectively, the market transforms. You stop chasing, you stop forcing trades, you stop fighting the chart. You begin to see what most traders overlook: the flow, the structure, the behavior patterns repeating themselves every single day. Your clarity increases, your decisions become precise, and losing money becomes something that happens only when it aligns with your predefined risk, not because of psychological weakness. Never lose money is ultimately a mental discipline. It is a commitment to protect your capital above everything else. It is a promise to yourself: I will not let my emotions make trading decisions anymore. Discipline protects capital more than any strategy, because capital is not lost in the moments when the market moves against you. It is lost in the moments when your internal structure collapses under pressure. A strategy is nothing more than a set of rules that define what you should do. Discipline is the force that determines whether you actually do it. You can have the most accurate system, the cleanest technical setups, and the finest market knowledge, but if you cannot execute with consistency, none of it matters. The market offers endless opportunities, but it also offers endless traps for those who cannot control themselves. Every trap is psychological. Every escape is disciplined execution. Most traders believe that once they find the perfect strategy, the losses will disappear. They believe that the right indicator, the right pattern, the right combination of signals will give them the confidence they need to trade flawlessly. But confidence does not come from a strategy. It comes from the disciplined repetition of correct behavior over time. A trader without discipline will break rules, exit too early, hold too long, increase lot sizes impulsively, and let emotions take over. A disciplined trader, even with an average strategy, will protect capital simply by executing the same set of behaviors over and over again without deviation. In trading, the consistent execution of a mediocre plan outperforms the inconsistent execution of a brilliant plan every single time. Discipline begins long before the trade is placed. It starts with the mindset you bring to the market. When you sit down at your desk, you bring your fears, hopes, expectations, and unresolved emotions with you. If you don't manage those internal forces, they will manage you. Discipline is the filter that blocks those impulses from influencing your decisions. It forces you to operate based on predefined rules instead of emotional reactions. Most traders underestimate how much internal noise affects their trades. A slight fear of missing out can cause you to jump early. A slight fear of loss can cause you to hesitate. A slight greed impulse can make you increase size. Discipline is what keeps you aligned with logic when those emotional forces try to take control. Capital is not protected by predicting the market. It is protected by managing yourself. When you lose discipline, capital leaks away quietly, sometimes slowly, sometimes violently, but always predictably. A trader who breaks rules occasionally will eventually break them consistently. Once your mind learns that rules are negotiable, they lose all power. The market will always test your weakest point. If your weakness is impatience, it will show you rapid movements that trigger impulsive entries. If your weakness is fear, it will show you fake breakouts that push you out early. If your weakness is greed, it will tempt you with large moves right after you increase size. Discipline is the structure that prevents you from falling for these traps. One of the biggest misunderstandings in trading is that discipline is a form of restriction. Many traders think discipline takes away freedom. In reality, discipline gives you freedom, the freedom from uncertainty, fear, hesitation, and regret. When you act with discipline, you no longer question your decisions because the decisions are not emotional, they are mechanical. You know exactly what to do because you have already defined it. The only task left is execution. The mental pressure dissolves. Because you are no longer trying to control the market, you are only controlling yourself. This shift is what separates a consistent trader from an inconsistent one. Strategy defines the opportunity, discipline defines the outcome. Two traders can trade the exact same setup and end with completely different results. One trader cuts losses at the predefined stop and waits for the next opportunity. The other refuses to accept the loss, widens the stop, holds the drawdown, and destroys capital. The difference isn't strategy, it's discipline. The disciplined trader survives long enough to let probabilities work in their favor. The undisciplined trader never survives long enough to experience the power of consistency. Discipline also protects capital by enforcing risk management. You can't control how far the market moves, but you can control how much you are willing to lose. Many traders believe they are applying risk management, but they are only applying it when the trade feels comfortable. When pressure increases, they override the rules. They close early when they should hold. They hold when they should close, and they increase size when they should stay steady. Discipline is what prevents you from violating your own boundaries when emotions try to push you beyond them. A trader with discipline never allows a small loss to grow into a catastrophic one. They never allow a winning streak to turn into overconfidence. They never allow a losing streak to turn into revenge trading. Capital is preserved not by the quality of the setup, but by the quality of the decisions surrounding it. To develop discipline, a trader must build internal trust. This trust is not in the market, not in the strategy, but in their ability to follow their own rules. When you trust yourself, hesitation disappears because you know you will act according to plan. When hesitation disappears, confidence grows. When confidence grows, the mind becomes calm. A calm mind sees the market with clarity. It does not fear entries or exits. It does not chase. It does not freeze. It simply observes and executes. This state of mind is where discipline becomes effortless. It no longer feels like a task. It becomes part of your identity. The most powerful aspect of discipline is that it compounds. The more you follow your rules, the stronger the habit becomes. Each disciplined action strengthens the mental framework that supports consistency. Each time you avoid a bad trade, cut a loss quickly, or stick to your size limits, you reinforce the internal identity of a disciplined trader. This identity becomes the foundation of long-term success. Strategies can change, market conditions can change, but discipline remains constant. It is the anchor that keeps you stable in unpredictable environments. Without discipline, you are gambling, no matter how advanced your strategy appears. With discipline, you are trading, even if your strategy is simple. The market rewards those who can control themselves, not those who can predict price movements. Every moment in the market is a test of your psychological structure. Discipline is what allows you to pass those tests consistently and protect the one thing that keeps you in the game, your capital. Losses shrink when emotions are removed from decisions because emotions distort perception, magnify uncertainty, and shift your focus away from the probabilities and toward the immediate sensation you are feeling in the moment. Trading is an environment of constant ambiguity, where every tick carries both opportunity and threat. Without emotional control, your decisions become reactions rather than responses. You start trading not based on your plan, but based on your fear of loss, your desire for gain, or your discomfort with waiting. When emotions dominate, logic becomes secondary. When logic becomes secondary, losses expand naturally, almost effortlessly, without you realizing how quickly your control is slipping. Removing emotion is not about becoming robotic. It is about creating enough internal clarity that the market cannot manipulate your mental state. The market triggers emotional responses because it activates the deepest psychological mechanisms related to risk, safety, and uncertainty. Fear appears the moment the candle moves against you. Greed appears the moment it moves in your favor. Impatience appears whenever the market is slow. These emotions create impulses, forces inside your mind that push you to act prematurely or to avoid acting altogether. When you place a trade out of fear, it is usually late. When you exit out of fear, it is usually early. When you hold out of greed, the market often reverses. When you refuse to take profit because you want more, you frequently walk away with less. Emotionally driven decisions are expensive because they disconnect you from the rules that protect your capital. You end up fighting the market instead of flowing with it. Losses shrink when emotions are removed because decisions become consistent. Consistency is the core of profitability, and emotions destabilize consistency by making you behave differently under pressure than you do in calm conditions. You might promise yourself that you will stick to your stop loss, but when fear intensifies, the mind creates justification to move it. You may vow to follow your setup criteria, but when greed appears, you jump in early. You may decide to wait for confirmation, but when impatience builds, you force a trade. In each case, emotion overrides the system. When emotions are removed, rules regain their authority. You follow the plan as it is, not as your feelings interpret it in the moment. This is why consistent traders do not eliminate losses entirely, but they eliminate unnecessary losses, losses created by impulsive emotional behavior. Trading becomes much more manageable when emotions are quiet because you see the market objectively. The chart is no longer a source of threat or excitement. It becomes a flow of information. You start recognizing patterns without distortion. You make decisions based on facts rather than feelings. The moment your emotional noise decreases, your clarity increases. You no longer exaggerate the importance of a single candle or overreact to a small move. You stop expecting every trade to be a winner and start focusing on executing correctly. This shift in perspective alone can reduce your losses dramatically because you stop taking trades that have no edge and you stop holding on to trades that violate your rules.
Yeah.
Emotion-free decision-making is built on acceptance. Acceptance of uncertainty, acceptance of risk, and acceptance of loss is a normal part of the process. Most emotional turmoil comes from resisting reality. Fear arises because you cannot accept that the market may move against you. Greed arises because you cannot accept that the profit you have right now may be enough. Impatience arises because you cannot accept that the market will move on its own time, not yours. When you accept reality, the emotional charge behind these reactions begins to dissolve. You stop fighting the market. You stop fighting yourself. You begin to align with the flow instead of resisting it. This alignment is where disciplined decision-making becomes possible. Removing emotions does not mean suppressing them. Suppression only makes them stronger. Removing emotions means designing processes, routines, and structures that minimize the emotional impact on your decisions. A predefined plan reduces uncertainty. A fixed risk percentage reduces fear. A mechanical stop loss removes hesitation. A structured routine before entering a trade resets your mind. Journaling helps release emotional residue from previous trades. All of these practices are not for the strategy, they are for your mind. They create a psychological environment where emotional impulses have no room to influence your execution. The more structure you have, the less pressure emotions can exert on your behavior. Losses shrink when emotions are removed because your trades become smaller, quicker, and cleaner. You take fewer unnecessary trades, which eliminates emotional losses created by boredom or impulsiveness. You respect your stop loss, which prevents small losses from turning into large ones. You avoid over-leveraging, which keeps drawdowns manageable. You stop revenge trading because you no longer feel a need to prove anything to the market. You begin to understand that every trade is just one of many, not a defining moment of your skill or identity. This mindset detaches you from outcomes and reco. Connects you with process. The process is what protects capital. The process is what shrinks losses. When emotions are removed, patience becomes natural instead of forced. You wait for the right setup not because you are trying to be disciplined, but because you genuinely feel no pressure to participate in every move. You stop chasing because you no longer fear missing out. You stop exiting early because you no longer fear giving back unrealized profit. You stop forcing trades because you no longer feel anxiety and stillness. Patience is the byproduct of emotional neutrality, and patience alone eliminates a massive percentage of the losses that traders experience. The absence of emotional decision-making also strengthens your ability to let winners run. Many traders cut winners early not because the market gives them a signal, but because the internal fear of losing the profit becomes unbearable. This fear comes from attaching emotional weight to each trade. When that attachment dissolves, you allow the trade to reach its logical outcome. You follow the structure, not the fear. As a result, your average win increases while your average loss decreases. This mathematical shift alone can transform a struggling trader into a profitable one, even without changing the strategy. Emotion-free trading is not about eliminating humanity, it is about eliminating distortion. You cannot control the market, but you can control your state of mind. When your mind is calm, the market loses its ability to intimidate you or seduce you. The candles stop triggering emotional reactions. You stop interpreting movements as personal attacks or personal opportunities. They simply become information, neutral, objective, and predictable in their uncertainty. A calm mind makes rational decisions naturally without force. And rational decisions are what keep losses small, controlled, and manageable. Losses shrink because emotions add size, speed, and drama to every mistake. Fear magnifies a small loss into a large one. Greed magnifies a small profit into a loss. Impulse magnifies a small opportunity into a big setback. When emotions are absent, mistakes still happen, but their cost is minimal. The damage is contained. The consequences are small. You recover quickly, emotionally and financially. You stay in the game long enough for the probabilities of your system to work. And staying in the game is the ultimate requirement for long-term success. Acceptance of risk eliminates fear in execution because fear is born from resistance, and resistance appears only when you have not fully acknowledged or embraced the possibility of losing. Every trader who hesitates, doubts, or second-guesses their decisions is reacting not to the market itself, but to the internal conflict created by unaccepted risk. When you accept risk completely, that conflict disappears. The market can move up or down, fast or slow, in your direction or against you, and your mind remains stable. Without acceptance, every movement feels threatening. With acceptance, every movement becomes information. This shift is what allows you to execute trades with clarity rather than anxiety. Most traders think they have accepted risk simply because they set a stop loss or choose a lot size, but these are mechanical steps, not psychological acceptance. Psychological acceptance means you are genuinely at peace with the possibility of being wrong. It means the outcome of a single trade holds no emotional weight. It means you enter the market with full awareness that the result is uncertain and you are prepared for any scenario without fear, frustration, or disappointment. When this level of acceptance is missing, fear fills the space. You hesitate to enter. You hesitate to exit. You close trades too early. You widen stops. You take profits prematurely. Fear becomes the decision maker, not your system. Fear is powerful because it distorts perception. When you have not accepted risk, you see danger in places where none exists. Normal pullbacks feel like reversals. Simple consolidations feel like traps. Late entries feel necessary because you fear missing out. Early exits feel smart because you fear losing what you have. You lose the ability to see the chart objectively, and without objective perception, your decisions collapse into emotional reactions. Acceptance of risk removes the emotional charge behind price movement, allowing you to see the market for what it truly is, neutral and impersonal. When fear dominates, your mind tries to protect you from emotional pain by altering your behavior. It convinces you to avoid taking trades, even when your setup is present. It convinces you to hold losing trades because accepting the loss feels too painful. It convinces you to take profits early because the fear of losing them is unbearable. But when you accept risk deeply, there is nothing left for fear to protect you from. The emotional pain that fear anticipates no longer exists. You enter and exit without hesitation because you are not trying to avoid anything. You are simply following your plan. This is why traders who master risk acceptance often describe the market as becoming quieter, slower, and less intimidating. The market hasn't changed. Their relationship with uncertainty has. Acceptance of risk also creates freedom. The freedom to execute your system without mental interference. When you truly accept that you could lose on any trade, you stop trying to control the market. You no longer demand a specific outcome. You do not hope for a win or fear a loss. You simply allow the probability to play out. This freedom enables fluid execution. Your entries become clean. Your tops are respected. Your targets are approached with patience. You no longer sabotage your own trades. This internal freedom is what allows consistency to emerge, because consistency requires repetition, and repetition is impossible when fear disrupts your behavior. Many traders misunderstand fear as a natural part of trading. They think fear is something they must endure or overpower. But fear should not exist once risk is accepted. If fear is still present, it means the acceptance is incomplete. Deep acceptance means you can place a trade and feel absolutely nothing. Not excitement, not anxiety, not tension. You simply observe. The trade no longer feels like a threat to your identity or your capital beyond what you have already agreed to risk. In this state, discipline becomes effortless because fear is no longer trying to pull you away from your plan. Another powerful effect of risk acceptance is the elimination of hesitation. Hesitation comes from uncertainty, and uncertainty comes from fear. When you fully accept the risk, hesitation disappears because you already know everything that could happen, and you are mentally prepared for all outcomes. You do not need reassurance from the chart. You do not need confirmation from the market. You trust your system enough to take the trade, and you trust yourself enough to follow through. This absence of hesitation leads to precise execution, and precise execution is what separates profitable traders from struggling ones. Risk acceptance also prevents emotional compounding. When one small emotional reaction leads to a chain of destructive decisions, for example, a trader who hasn't accepted risk may take a small loss and feel emotional discomfort. That discomfort triggers the desire to win it back. That desire triggers impulsive trades. Those impulsive trades cause larger losses. Those losses trigger frustration. Ion triggers revenge trading, and the cycle continues. Acceptance of risk breaks the chain at the first link. The small loss does not feel painful because it was already accepted mentally before the trade was placed. Since it creates no emotional reaction, nothing is triggered afterward. A single loss stays a single loss instead of spiraling into a catastrophic session. When you accept risk, your stop loss becomes a tool, not a threat. Many traders fear stop losses because they view them as punishments or failures, but a stop loss is simply a predefined point where the cost of staying in the trade no longer aligns with your plan. It is not personal. It is not emotional. It is a business expense. When you accept risk, your stop loss becomes part of the natural flow of trading. You respect it without hesitation because you see it as protection rather than punishment. Acceptance of risk also strengthens your ability to let go of the need to be right. The need to be right is one of the greatest sources of fear in trading. When you believe your self-worth is tied to the outcome of a trade, every losing position becomes a threat to your identity. This creates emotional pressure, and emotional pressure creates fear. But when you accept risk, you simultaneously accept that being wrong is normal, expected, and irrelevant to your identity. You free yourself from the ego-driven requirement of accuracy. You focus instead on executing well. Execution, not accuracy, produces consistent profits. By accepting risk, you shift your mindset from outcome to process. You stop caring about the result of a single trade and begin to care about the integrity of your decisions. Each trade becomes just another event in a long series of events. This detachment allows you to remain calm, even during drawdowns, because you are no longer emotionally attached to individual results. Your belief is anchored in the long-term probabilities, not the short-term fluctuations. Ultimately, acceptance of risk eliminates fear because fear cannot survive in a mind that has nothing to resist, nothing to protect itself from, and nothing to prove. When you accept risk at a deep psychological level, fear loses its power, and execution becomes a natural expression of your trading plan rather than a battle between logic and emotion. Consistency comes from managing behavior, not predicting markets, because the market is inherently uncertain, uncontrollable, and constantly shifting, while your behavior is the only element in the entire trading process that you have complete power over. Most traders enter the market with the belief that success depends on correctly forecasting price movement. They search for patterns, indicators, signals, or special formulas that promise certainty. But no matter how advanced the system is, it can never eliminate randomness. Every trade carries an unknown outcome. Every setup holds possibilities, not guarantees. When traders try to force certainty where none exists, they create psychological tension, and that tension leads to emotional decisions. Consistency is not born from knowing what the market will do next. It is born from knowing what you will do next, regardless of what the market does. The behaviors that create consistency have nothing to do with prediction and everything to do with the ability to execute a plan without emotional interference. Behavior shapes risk management, timing, patience, discipline, and emotional stability. Prediction is a guess. Behavior is a skill. A trader who tries to predict the market is reacting to external forces. A trader who manages their behavior is shaping internal forces. External forces are chaotic and uncontrollable. Internal forces can be trained, developed, and mastered. This is the first truth, Eve. Successful trader realizes profits come from behavior, not forecasting. Many traders create strategies that perform well during testing but fail during live markets, not because the strategy is flawed, but because their behavior changes under pressure. Fear causes hesitation. Greed causes overtrading. Impatience causes forced entries. Anger causes revenge trades. When your behavior collapses, your strategy collapses with it. Consistency is impossible when your actions shift based on emotion. You may have a winning strategy, but if you cannot behave consistently, you will produce inconsistent results. This is why two traders can use the same charts, the same system, the same indicators, and still experience completely opposite outcomes. The difference is behavior. Managing behavior means learning how to respond to uncertainty with stability. It means accepting that you cannot control price, but you can control your reaction to price. Most traders believe they need to know the future before entering a trade. But consistent traders enter not because they know the future, but because they trust their process. The edge lies in behavior, repeated over hundreds and thousands of trades, not in guessing where the next candle will close. Prediction creates pressure. Behavior creates flow. Markets punish those who behave inconsistently. If you widen your stop loss today because you don't want to take a hit, you teach your mind that rules are flexible. If you chase a move because you fear missing out, you reinforce impulsive behavior. Every small behavioral deviation strengthens the habit of inconsistency. Once inconsistency becomes normal, discipline disappears. Without discipline, you cannot protect capital. Without protection, you cannot survive long enough for your edge to play out. The more inconsistent you become, the more emotionally unstable you feel, and the further you drift from profitable performance. Consistency begins with emotional neutrality. You must reach a mental state where a win feels the same as a loss in terms of emotional intensity. When wins excite you, you become reckless. When losses bother you, you become fearful. Both states damage behavior. A neutral mind can execute without pressure because it is not emotionally attached to outcomes. You become consistent when your emotional state does not fluctuate with the chart. This emotional stability allows you to follow your rules in both favorable and unfavorable conditions. Managing behavior also means defining rules that are clear, simple, and unbreakable. If your rules are vague, your behavior becomes unpredictable. If your rules are complex, your mind becomes overwhelmed under stress. Consistent behavior is easier when you operate with clarity. Your entries, exits, risk percentage, and trade management must be predetermined. When these elements are decided ahead of time, you reduce the cognitive load during execution. This prevents emotional improvisation, the primary cause of inconsistency. Another critical aspect of behavioral management is routine. Your environment, preparation, and daily habits shape your mental state before you even open the chart. Traders who approach the market without a routine bring chaos into the session. A structured routine creates mental order. Order reduces emotional noise. Reduced emotional noise strengthens disciplined behavior. This is why professional traders emphasize preparation as much as execution. Consistency is not something that happens during a trade. It begins before the trade is placed. Behavioral consistency also requires understanding and respecting probabilities. When you base your identity as a trader on winning or losing, you tie your emotions to each outcome. But when you base your identity on executing the process, outcomes lose their power over you. A single loss means nothing because you are not measuring success on that scale. Your measurement becomes, did I follow my rules? Did I behave the way a consistent trader behaves? When these are your metrics, anxiety disappears. Fear disappears. Pressure disappears. You operate from calm objectivity instead of emotional reactivity. Predictive traders constantly look for confirmation before entering the market. They want certainty, but the market never gives it. When you rely on prediction, you hesitate because you are waiting for something that may never come. This hesitation itself breaks consistency. Behavior-based traders act because their rules tell them to act, not because the market offers reassurance. They behave consistently regardless of whether the setup looks perfect or uncomfortable. They understand that discomfort is part of trading. Their behavior does not change based on emotion. It remains anchored in the plan. Managing behavior also involves managing expectations. Unrealistic expectations create emotional volatility. If you expect every trade to win, every loss triggers frustration. If you expect the market to move immediately in your favor, any delay produces impatience. If you expect a single trade to make up for past losses, greed takes over. Behavior collapses when expectations are misaligned with reality. When you align expectations with probability, volatility, and randomness, behavior stabilizes naturally. Consistent traders view losses differently than struggling traders. Struggling traders see losses as failures. Consistent traders see losses as normal events within a larger probability distribution. This mindset keeps their behavior steady regardless of outcome. When you stop taking losses personally, your actions stop being influenced by fear or frustration. You simply execute the next trade W, the same clarity as the previous one. This is behavior-based trading. Prediction-based traders jump from strategy to strategy, always searching for the system that will eliminate uncertainty. Behavior-based traders refine themselves, not their strategies. They improve patience, emotional control, discipline, and execution. They understand that the strategy is only as good as the person applying it. A great system in the hands of an emotionally unstable trader produces poor results. An average system in the hands of a behaviorally disciplined trader produces consistent results. Consistency emerges when your behavior remains stable regardless of market conditions. You follow your plan during uptrends, downtrends, ranges, high volatility, and low volatility. Your actions don't shift based on mood, bias, fear, or excitement. You operate the same way every day. This stability creates a predictable pattern in your execution, which produces consistent results over time. Trading becomes a process rather than an emotional roller coaster. When you stop trying to predict the market and start managing your behavior, you remove the biggest variable that destroys consistency: uncertainty about your own actions. You may not know what the market will do next, but you must always know what you will do next. This is the essence of consistency and the foundation of long-term profitability. Small controlled losses are the cost of staying profitable because trading is not a game of perfection, but a game of probabilities, and probabilities require room to breathe. Every system, every strategy, every methodology, no matter how refined, contains losing trades as a natural and unavoidable component. Trying to eliminate losses leads to hesitation, fear, overanalysis, and eventually catastrophic decisions. But accepting small controlled losses as a business expense transforms your relationship with the market. You stop resisting the inevitable. You stop trying to win every trade. You stop fighting uncertainty. Instead, you begin to operate from a space of clarity, where preserving capital matters more than proving a point to the market. Most traders lose because they refuse to lose small. They avoid the discomfort of a planned minimal loss, and in doing so, they create much larger, destructive ones. They move stops, they justify staying in trades, they hope for reversals, and they allow a manageable situation to spiral into a devastating outcome. Small losses are never the cause of account destruction. Large emotional losses are. The trader who cannot tolerate a small controlled loss inevitably ends up facing a large uncontrolled one. This is why accepting small losses is a sign of strength, not failure. It shows you are committed to survival, and survival is the foundation of profitability. A small controlled loss preserves your mental clarity. When you stick to your predefined risk, you maintain the psychological stability needed to continue trading effectively. You do not enter a spiral of frustration. You do not feel the urge to revenge trade. You do not create emotional baggage that spills into the next decision. Instead, you take the loss, record it, and move on, because the loss aligns with your plan. The loss has a purpose, and because it has a purpose, it carries no emotional weight. Your mind remains sharp, calm, and prepared for the next opportunity. Small losses also give your edge the room it needs to express itself. No strategy wins 100% of the time. Even the best strategies rely on a sequence of outcomes where wins outweigh losses in the long run. If you prevent the small losses from happening by refusing to close them, you interrupt the sequence and distort the mathematics of the system. Your strategy cannot work because You are not allowing its probabilities to unfold naturally. Consistency comes from letting the small losses occur because they are part of the statistical pattern that leads to long-term profitability. When you avoid small losses, you break the very structure that could have made you profitable. Controlled losses create emotional discipline, which is essential for success. The act of accepting a loss reinforces the behavior of following rules. Each time you take the loss exactly as planned, you strengthen the neural pathways associated with discipline and weaken the ones associated with fear or avoidance. Over time, taking a stop loss becomes effortless, automatic, and unemotional. When you reach this level of behavior, your trading becomes more precise, calm, and objective. You no longer see losses as threats. You see them as part of doing business. This mindset is what separates professionals from amateurs. Small controlled losses serve another critical purpose. They protect your future opportunities. A trader who refuses to accept a small loss often finds themselves with significantly less capital, which limits their ability to take quality setups later. Good opportunities appear endlessly in the market, but you can only benefit from them if you still have capital and a clear mind. The trader who blows up their account or suffers a deep drawdown due to one emotional mistake loses access to future probabilities. The trader who respects small losses keeps themselves financially and mentally ready for the next trade. Opportunity is a continuous flow, and small losses ensure you remain in the flow. The power of small controlled losses becomes even more evident when you understand their relationship to compounding. Consistent traders do not rely on occasional huge wins. They rely on steady growth, achieved through disciplined execution and controlled risk. A single large loss can erase days, weeks, or even months of progress, but a series of small losses barely disrupts the curve of growth. Because they are controlled, they are expected. Because they are expected, they do not destabilize your psychology or your account. This protects your compounding effect, slow, steady, relentless accumulation over time. Compounding thrives in stability, and stability is created through controlled losses. Another important aspect is confidence. Confidence does not come from winning trades. Winning trades feel good, but they do not build the psychological foundation needed for long-term success. True confidence comes from knowing that you can follow your plan under pressure. It comes from respecting your risk consistently, even in difficult moments. When you demonstrate to yourself that you can take small losses without emotional reaction, you build deep trust in your ability to manage uncertainty. This trust becomes an anchor during volatile sessions. It prevents panic. It prevents impulsive decisions. It allows you to execute with calm certainty, even when the market behaves unpredictably. Small losses also shift your mindset from perfection to professionalism. Perfectionists cannot survive in the market because the market will always prove them wrong. Professionals thrive because they expect to be wrong and prepare for it. When you accept small losses as the cost of trading, you step into a professional mindset. You stop viewing each trade as a test of intelligence or skill. You see it as a probability event, one of many. This detachment liberates you from emotional swings. You no longer take losses personally. You no longer allow outcomes to define your mood or your identity. You trade with maturity instead of ego. The concept of small controlled losses also eliminates the fear of losing. When you know your worst case scenario is small, predefined, and manageable, fear dissolves. Fear only exists when the mind imagines catastrophic outcomes, but in a system of controlled losses, catastrophic outcomes are impossible unless you violate your own rules. This realization brings freedom to your execution. You enter trades confidently because you are no longer afraid of what might happen. You accept the risk fully because the risk is contained. This containment of risk is what gives birth to consistent behavior. Taking small losses willingly also reinforces patience. When you know that you can exit quickly and cleanly, you no longer feel pressured to force trades. You wait for proper setups because you trust your ability to manage risk. This creates a cycle. Controlled losses increase patience. Patience increases quality of trades, and quality increases profitability. Everything begins with the willingness to take small losses. Over time, small controlled losses shape your identity as a trader. You become disciplined, structured, objective, and calm. You begin to think in terms of probabilities rather than certainties. You stop trying to avoid losses and start trying to execute perfectly. You stop aiming for perfection and start aiming for consistency. You stop fighting the market and start flowing with it. And in this flow, profitability becomes a byproduct of behavior rather than prediction.